Hi everyone, I'm Carly Esterhazen, Marketing Officer at Easy Equities, and I'm thrilled to be your MC at InsureTalk55. Can you believe it? Now, insurance is powerful. This industry protects people, communities, and economies, and today we're zooming out to look at some of the global lessons and perspectives on catastrophic risks. At Easy Equities, I'm so proud that we're part of this world. With our asset-aware life insurance, Easy Protect, backed by Sanlam, it's just great to be here and among this community. Now, before we dive into today's lineup, I want to give a huge shout out to our headline sponsor, Sasria, a unique South African insurer providing cover for risks that are typically excluded from traditional insurance, like strikes, riots, civil commotion, public disorder. Their work is crucial to maintaining resilience across our nation's economy. Let's get started. Okay, our first speaker is Hayley Clark, Chief Actuarial Officer at Sasria. She's going to be opening the conversation with a global lens. She's going to be exploring catastrophic protection gaps and potential solutions, from modeling insights to community resilience.
Great. Good morning, everyone. So let me just share my slides here. Excellent. So today I'm planning to cover a very wide topic on catastrophe risks, the protection gap, and then solutions to manage this growing protection gap that we face. And that's because we really can't get stuck in these problems, but we need to actually focus on what we can do to solve them. So starting with the disaster risk landscape. This chart shows the global NatCat events from 2024, so NatCat being natural catastrophe events. And what we can see is there were many catastrophes happening around the world. And while we can see the losses in the developing economies may look quite small in terms of the size on a global scale, they can actually have a very big impact in terms of the national economies on their total economic output. And the map also doesn't fully illustrate the disparity that we see between the financial and human impacts. You know, in the developed economies, they're much better prepared to deal with these types of events when they happen. Globally, we see that catastrophe losses have increased, and these images are from all around the world from the last year, and we see that the impact has been across both the developed and the developing markets. We see there's been many floods, there's been some major hurricanes, as well as some serious wildfires around the world. And the losses have increased, especially over the last number of years. And the reason for that is firstly, the exposure in assets have increased, and particularly through the increase in urbanization in high-risk areas, and then also with the growth in the value of assets. And it's not only for NatCat events that we're seeing the risk increasing, but also within major man-made events, and in particular, the strike, riot, and civil commotion area. That's the SRCC type of business. What we saw is that, prior to the last few years, the largest loss on record was back in 1992, where there were Los Angeles riots of around $1 billion. But in just the last couple of years, there have been so many major SRCC type of events that it's really become a prominent sort of talking point among the insurance industry. And then what we know is the risks are actually changing as we're going. Firstly, when it comes to NatCat, climate change is completely changing the risks. So we're seeing a lot more frequency and severity of NatCat events. What we do know is for every 1 degree of warming, the atmosphere can hold 7% more moisture. So that changes rainfall patterns. But it's also not as simple as that, because ultimately it can change the overall atmospheric and ocean circulation, and that is what impacts the global climate. For man-made events, there are also a number of different reasons for the increase in losses, especially on the SRCC side. Firstly, there's things like civil unrest, which is coming from political polarization as well as economic inequality. But the main thing that stands out as having changed this landscape is the amplification of social media. So particularly things like Facebook and X, these platforms have allowed sort of the mobilization of masses at a much greater speed than in the past. So what we can say is that we are living in this age of catastrophic events. I mean, just looking at South Africa alone, our insurance industry has gone from event to event in the last number of years. I mean, it started really with the COVID-19 business interruption losses that happened in 2020. From there, we had the KZN rioting and looting in 2021, and then the KZN floods in 2022, all of these being really big events that we hadn't experienced before. And then there's also the issue that we're seeing, or another change within the NatCat space, and that is the fact that we've got an increase in what is termed secondary perils. So within the insurance and reinsurance industry, it's not clearly defined what a primary and a secondary peril is, but really it's seen that primary perils are those individual sort of peak losses that can create major societal impacts. So things like your earthquakes, your hurricanes, and European windstorms. So those are the ones that are primary perils within this chart. But what is really becoming quite concerning is how the accumulation of the secondary perils is adding up to a lot more than the primary perils. And we can see that in terms of this trend over time. And these are things like our flooding and hailstorms. And they need to be addressed differently because of the fact that that frequency is the problem there. So we need to look at ways to build in resilience. If we then go on to the protection gap, and this is a key challenge around the world. The protection gap refers to the difference between the insured and economic losses from an event. And what's been stated is that only about 30% of global economic losses since the year 2000 were covered by any form of insurance. So that's about a 70% gap. The gap is, as we can see, most pronounced in many parts of Africa, Latin America, and in Asia. But I'd say, in addition, it's the humanitarian impacts of these catastrophes that must be considered, because they can often cause complete livelihood losses for poor communities, and that you don't really see within the numbers because, from an economic number standpoint, it actually can be quite small. And what it does is having this big protection gap across society can have long-term societal impacts, and it really perpetuates a cycle of inequality and poverty. And I'm going to talk a lot about drought throughout the presentation, but in the face of droughts, what we see is that communities need to put in place coping mechanisms. So often families will decide that they need to cut costs elsewhere in things like nutritious food, healthcare, and schooling. And what this does is it not only impacts the family or the individual over their life, but it can also impact the economy and the future development of the country for years to come. So it's a much bigger problem. If we look at some of the larger events that we've experienced in South Africa, what we find is that the KZN fires back in not the KZN Knysna fires back in 2017 had about a 20% gap. The July 2021 protests resulted in around a 37% gap, and the KZN floods were around a 50% gap. So in some ways, these numbers indicate that the gap doesn't appear too high in South Africa against this global average of 70%. But as I say, these numbers really don't capture everything. We know that there was a large loss of life. There were over 350 people who lost their lives in both the 2021 and 2022 events. And then there's an ongoing impact, especially for sort of the uninsured, including the informal traders and uninsured households, which really struggle to recover ever, and that just deepens the inequality. Then I will state that in South Africa, droughts are over 99% uninsured. There's very few available insurance options, both for smallholder farmers as well as for commercial farmers. Now, before tackling the problem, we need to understand what the drivers are of the protection gap, and they're quite numerous. And it's quite interesting in South Africa. We're unique in that we've got quite a distinct type of market. On one hand, South Africa has quite an advanced market that, benefits certain parts of society, but then we also have a very large portion of uninsured people in the country. So we need to look at these differently and tackle them differently. So from the well-developed market standpoint, some of the challenges relate to insurance supply disruption. And that's where there is a demand for insurance, but the supply or the cover is no longer available. And this often happens after large events. So for example, in the case of the large flooding in KZN, what that leads to is insurers trying to pull out of the market or increase their limits, say, and that exposes these high-risk areas more. We also see that insurance costs have gone up substantially, especially things like reinsurance, and often insurers then pass these costs down to the policyholder, so that then increases the cost and can make it unaffordable. And then something that concerns me quite a bit is the fact that as we get better data and better modeling, it means that we can more accurately pinpoint risks, and then each sort of property can be priced exactly according to their risk. And what this does is it can price out many of the high-risk properties in the market. And this is a place where government often will step in because they need to make sure that there's a wider pool of risks for insurance to work. Then if we look at the uninsured part of South Africa and what's causing the gap there, I mean, of course, there's affordability because we have high poverty and unemployment, but also access to insurance because at the same time, there are, not necessarily products that are suitable. There's also the issue of a lack of understanding of the risks that they may face, as well as what sort of products are available, and then a mistrust in the insurance industry. And finally, an expectation that possibly government should step in the face of disaster. We do note that there is a lack of risk pools within the natural disaster space in South Africa. So we do have SASRIA is a risk pool which is covering civil unrest and terrorism, but we don't have anything for the natural disaster risks. So what we've stated is really disasters have major impacts across different parts of society. So of course it does affect individuals and businesses, but it has an equally devastating impact on the public sector. So that's both through increased costs and lowered revenue. So that's why closing the protection gap remains a systemic challenge for national governments, communities, and the insurance sector. The risks also extend beyond the insurance sector. And so we see there's a rising challenge within, say, the banking space, where, for example, properties may be insured with a 20-year mortgage. But if we can no longer get insurance on that property, that leaves banks highly exposed. And that creates further knock-on effects to the property market. Similarly, for businesses, they want to invest in places where they can, be able to get insurance. So investment decisions are also driven by the availability of insurance. What we've seen from events that have happened in the past is where there are available economic resources, it really helps societies recover. So in the face of the New Zealand earthquake that happened in 2011, most of the losses were insured. So a lot of money came from the international community and from reinsurers, which then allowed the economy to actually rebound quite quickly. So it stimulated the economy there. Whereas without adequate insurance, what it does is it makes the governments or aid organizations need to pay for the losses. And it's particularly challenging when it comes to the government having to pay for it because often it's not planned for, so it requires budgetary allocations. And that means then other things, you don't spend money on service delivery and other areas which are quite crucial in terms of the development of a country. So it does hold that back quite substantially. So we need to have this balance for governments, especially between responding to disasters as well as planning, building in resilience and planning for future disasters. And something that we are seeing is governments are becoming more and more concerned about this and seeing it as sort of macroeconomic issue to deal with. So now in the next few sections, I'm going to talk about a few different types of solutions and what needs to happen. So they cover a few areas. Firstly, we need to understand the risk better through data and modeling. We also need to look at innovative insurance solutions like parametric insurance, also national and regional risk pools, as well as risk mitigation. So starting with understanding the risk, and this is where catastrophe modeling comes into it. So catastrophe modeling is really quite key, and it's generally built around 3 different modules. So we've got the hazard module, which really looks at, say, in the case of earthquakes, it'll look at the frequency and intensity of potential earthquakes that could occur in the area. Then you need to look at your exposure. So that's the assets which could be exposed to an earthquake taking place. And then finally, the vulnerability, which takes into account things like, are there any building codes to reduce losses? And that is put together to manage to determine what the physical damage would be and a financial loss from that. So we note that there are a number of challenges that come with this. So firstly, data is always a key challenge because these models rely heavily on data. What we do see, we do need exposure data, and in South Africa, the exposure data is getting better and better in terms of the actual properties insured. But for example, if you want to look at flood modeling, you even need elevation data on a property, which is quite challenging because if you have a property next to a river, it makes a difference whether the building is right next to the river or if it's on an elevated property at the top. So that's a level of detail that we're not quite at yet. In terms of data on the hazards, it's also quite key because you need to have information about events that may be extremely rare. So what we see is where events take place more often, like US hurricanes, that's where the models are much better developed. And at the same time, what we know is that investment drives this. So it's quite often, it's based on commercial decisions. So insurers, reinsurers, and brokers develop models where there's more insurance. So that leaves large gaps in places like Africa. We are seeing also changes here where now there's more open source data, and I'm going to talk about this a little later, but where we can then better improve the models. Of course, there's other uncertainty. I mean, when it comes to the parameters, there's a lot of uncertainty there, and we can even have cases where two different models for the same type of hazard can have different outcomes. And then finally, there are a lot of concerns around transparency with the models because a lot of it is IP, so they can be seen as black boxes. What is also quite interesting, and we know this, is that no model is fully predictive, so there always are times when the model gets it wrong. And here are just a few interesting ones. I mean, the hurricane models that were in place for the US, at the start of the century, the losses were actually coming out at least twice as high as what the models were saying. And what it was seen is that ultimately within the models, there were some non-modeled exposures, things like business interruption, as well as demand surge. So that's when after a catastrophe happens, there's demand for, say, building, so it increases the pricing there. When you had the Chile earthquake in 2010, didn't expect the tsunami losses that took place. The 2011 Christchurch earthquake in New Zealand actually happened on a previously unknown fault. And what the main losses actually came from was liquefaction. And that's where the ground shaking was so intense that it turned it to liquid. So you can imagine that was something that was unexpected in the modeling. The Japan earthquake also got it wrong in terms of the impact on the nuclear facilities there. When we look at the Thailand floods in 2011, again, this was a known exposure, but the expectation in terms of what happened in terms of global supply chain disruption was the surprise. And even when we come to South Africa, an example here is for Sasria, the riots and looting, the actual costs from that were much higher than what was ever expected. And where it went wrong here is within those three circles is actually the vulnerability part, because that assumes that there will be some risk mitigation. And the risk mitigation in this case was the security forces sort of stopping the event from going too far. And that didn't materialize. So that was the challenge there. I think the other thing when it comes to trying to model the future is quite often it uses past data. Now, as we say, the risks are changing. Within the space of climate change, things are changing all the time. So past data may not reflect the future. There's also so many challenges around these connected and compounding risks. So it's quite difficult to model the societal impacts from an event when it can have knock-on effects elsewhere. So this just shows, the graph is showing the food price index, and we can see how it quite closely links to conflict. And quite interestingly, the food price riots that happened in 2007 in many places around the world, so places like Haiti, Africa, Bangladesh, they were actually caused by droughts that happened in places like Australia, which increased food prices there. So these wider issues are very difficult to model. Risk management is another key thing that needs to be considered. And I mean, if we don't manage the risk at the same time that we insure it, what it means is that insurance will just become more and more expensive. So, and this talks quite a bit to the flooding, and especially the Durban flooding, KZN flooding back in 2022. There's so many different options in terms of what can be done. It can be quite simple solutions. So things like it was identified that the alien vegetation growing along riverbanks had shallow roots. When it rained, they would all get uprooted and block culverts and cause flooding. So by just removing that alien vegetation, it can reduce the flooding risk. So a simple solution there. But there are also much more complex solutions, which are much more costly as well. So things like improving the canal infrastructure in places in Durban where it's known that it can flood. And so there is a lot of investment needed here, and we can see the challenges that Toyota did a lot of investment there, over 200 million of investment for risk management to prevent any future losses, things like raising all their doors, raising all their key machinery. So all of this can be very expensive, and not every business or individual has this type of money to spend. If we go on to other solutions around parametric insurance, now some of you may be familiar with this, others may not, but really how it compares to traditional insurance is our traditional insurance is usually indemnity insurance. So what it means is when an event occurs, we look at the damages, we notify our insurers, a loss adjuster will come and look, and then finally you'll be paid for the amount of loss that you've had. Whereas a parametric insurance process is a bit simpler. What happens here is a triggering event is defined up front. And if that event occurs, if it's triggered and it's verified by a third party, immediately you receive a payment. Now, the concept is not new with parametric. It's been around for about over 20 years. It's used a lot in spaces like the energy space, where a solar power plant may want to put in place parametric insurance to cover if there are a number of cloudy days that happen. So there's many different triggers that you can have. But more and more it's being used within the development space to broaden disaster risk coverage, and it's actually being sold to governments and NGOs to manage the risks there. And so the focus of the rest of the presentation will be around that sort of development space, parametric. They're sometimes also called weather index or index insurance. So the key features of it is really the speed of the payout. That is the key benefit. It's, as we say, as soon as it's triggered, the payment will be made. So what it means is it manages that what we call the liquidity gap, where in the face of a disaster, the faster you can respond, the less the sort of ongoing knock-on effects on ongoing losses. There also are no loss assessments required, and that sort of things. These sort of things can lower the costs, and that makes it a lot more accessible to a wider group of people, which is really good. So it works well for microinsurance, and it can be quite flexible, sort of filling gaps where traditional insurance doesn't quite provide cover. I will mention those matches. It seems like an excellent idea. There are a number of challenges that come with it, not challenges that can't be solved, but these are things to consider. And one of the key things is basis risk. So, and this illustration shows basis risk and how it really works. You've got an index trigger, and if we talk about it in the face of drought, it would be the index being a drought did occur, so say rainfall is very low, or did not occur, and the adverse event would be either you have a failed harvest or you don't have a failed harvest. So quadrant 1 is where you don't have a failed harvest, but also there was no drought, so there's no basis risk and no payout. Quadrant 3 is where, yes, you have a failed harvest and the trigger triggers, so you have a drought, so you get a payout, which is great. There's no basis risk. But we can have instances where, this quadrant 4, where you have a failed harvest, but the trigger doesn't say that there is a drought, which means you don't get any payout. So this is a challenge because it means you've paid a premium, you've had a loss, and you have absolutely no payout. So that's not good. Same in quadrant 2 is where you actually don't have a failed harvest, but the product triggers, so you get a payout without a loss. Now that may seem like not such a bad thing, but it has quite an impact in terms of the reputation of the product, as well as on the pricing, because it increases pricing substantially. So a lot of work needs to go into things like the trigger design in terms of making sure that it matches quite well what the event you're trying to cover is. And I mean, it's difficult here again, because if you want to cover sort of a 1 in 4 year return period loss, what that means is you increase your basis risk and the pricing can be quite high. At the same time, if you put it at a 1 in 50 year loss, it means that, it's less likely to have any basis risk. It's more likely they'll be very closely correlated. But the challenge there is you don't really get payouts, so people don't trust the product. It's also quite interesting to look at how well this works for different sizes of areas that you can cover, because if you're trying to cover an individual farm, it can be quite challenging. But if you cover a larger area, there's less likely going to be basis risk there. Of course, the pricing and affordability is very important, especially if we're trying to sell it to smallholder farmers. I will mention that around the world, these sort of agricultural covers are often done with subsidies. It's very unusual that they work well without any subsidy at all. Again, there's also legal and regulatory frameworks that need to change because this doesn't always fit in with your traditional insurance type of covers. However, in South Africa, we are seeing there are quite a few different pilot studies that have taken place. So our regulator is quite keen to explore how these products can work. And then finally, the key thing on this is really education and trust. Because when you're trying to sell it to smallholder farmers, you need to be very clear in terms of communication of how the product works. Farmers are often not aware of this, and so it takes quite a lot of trust building there. And then I'll note that, the challenge is you can still have losses. I mean, you may have a drought product and then have pests that cause losses, and that won't be covered. And at the same time, nothing can really cover against poor farming practices. So this just shows, and I mentioned that it's becoming more and more possible to develop these products due to open source data, which is a great thing. Now, this is illustrating, firstly, 3 different open source data sets which consider rainfall based on satellite data and modeled data. So the orange, the gray, and the yellow bars are these 3 different rainfall data sets compared to the actual Weather Service data over the last 20 or so years. And it's interesting, for all the different seasons, we can see how they do correlate quite closely, but are not exact. So that's a key thing when you're trying to put together a product, maybe using CHIRP's data. It doesn't necessarily exactly match the Weather Service, what actually happened on the ground. But we also want to look at how well does this correlate with, say, the yield from maybe maize yield being the key type of crop grown in the area. And interesting to note is if you were to set the trigger at about 400 mils of rainfall over the whole season. Now, of course, this is quite simplistic because we can't just take into account the rainfall over a whole season. But as I say, to illustrate the point, we can see that in 1992, when there was a particularly bad year, the product would have triggered for all the different data sets. Similarly, in the 2015-16 year, where again, if we even remember recently, we did have that major drought, it was bad yields, the product could have triggered. But the other years, for example, 2014 and 15, where none of the data sets would have triggered, yet it shows that there was a poor year. Similarly, in the 2006-7 year, which was particularly bad, for yields, some of the data sets would trigger and others wouldn't. So there's a lot of opportunity moving forward with this, but there are still challenges. I'll note that there are there's so many different types of products. So as I say, the rainfall over a season is quite simplistic, but there is another type of simplistic product that is quite commonly used. And it sounds quite complex when we say NDVI as a normalized difference vegetation index, but really it's as simple as you look at the vegetation through satellite. If it's green, it means the vegetation's great, there's no payout. If it's brown, the vegetation's not good, there's a payout. So it's as simple as that, and this is often used for livestock type of coverage, especially throughout Africa. Then at the same time, there are also ways to make the products a lot more complex. And the challenge with making them more complex is, of course, as we say, we have to explain them to farmers and they need to understand it to trust the product. So this is actually one, African Risk Capacity, which sells the product to governments. And quite interestingly, what they do is they built an entire model based on rainfall as the key input. So they look at different satellite rainfall data sets. They look at it over a 10-day period. And then they combine that with crop models and the growth stages of crops to try and determine a water requirement satisfaction index. So that would be their trigger, whether the crop has got enough water or not. At the same time, they then consider the population in the area and how vulnerable they are to try and determine a cost in order to make a payout specifically to the governments to respond to these types of events happening. The other great thing about having this model, which is on a 10 daily basis, is it can provide early warning in terms of food security and where there may need to be sort of response strategies happening going forward. Now, the next section is around different types of insurance solutions, so particularly around pools and what we call protection gap entities. So I would say we can talk for a long time on this one topic, but I've actually summarized it all into a single slide, so it's not going to give that much information. But really what it tries to do is transform uninsured risk into some sort of risk that can be packaged and then covered by the global insurance and reinsurance market. So the first type is your sovereign risk transfer type of covers. And the idea of this is that it's sold to governments. And the idea is to make sure that governments in the face of disaster can respond really quickly without having to do any sort of budget reallocations. So we've got a few different examples there from around the world. So they generally cover larger areas, so not just a single country. And I already mentioned African risk capacity, but it is one of my favorite type of sovereign risk transfer coverages, because what they've done is they cover not just drought, but they also include there's floods, tropical cyclone, and even outbreaks and epidemics. They sell it to a number of governments across the African continent. NGOs can also pay premiums. So because we know that in the face of food security crises, that NGOs will also step in, sort of the World Food Program, to try and respond. So they can also buy coverage to get fast financing there. And what happens is when the governments receive their payouts, there will be a pre-agreed plan. So it doesn't mean that when the government receives that, they spend the money anywhere. They actually have a plan in place to put that money towards where it needs to go. So it's quite a well-organized type of structure. And I'd say it's done really well in terms of responding to disasters across the continent. The other nice thing is because it covers many countries in Africa, unfortunately not South Africa, but because it covers so many countries, you can get a bit of diversification there, because sometimes with El Nino and La Nina, you might have parts of Africa that experience more or less rain. So at least having that diversification means that often it's not the same country that's being impacted every year. The next type is to look at national insurance schemes. And this is where governments create sort of domestic pools to transfer risk, to make sure that, especially where there's a market failure, so they try and sort of establish these pools for the national market. A couple of examples are, one is SASRIA. SASRIA was actually started not to cover natural disasters, but to cover the political risks. And it was post the 1976 uprising where the insurance market pulled out of all political risk coverage. So there was this big market failure. And that's where the government stepped in and created SASRIA in 1979 to cover this type of risk. There's many other examples like this around the world that do natural catastrophe type of coverage. And then I'll note there's also insurance for the more vulnerable sectors of society. So these sort of protection gap entities are where governments work quite closely with financial institutions or insurers to be able to develop and distribute products. And these are for uninsured population and often tailored to individuals, and often need premium subsidies too. So like the Kenya Livestock Insurance Program is a program that's been put in place to cover pastoralists, where it was seen that, their livelihoods were at risk in Kenya when a drought would happen, because of course the animals would die. So the idea is to respond very quickly with the idea to keep animals alive, respond before you get, far down the road in terms of the disaster, and maintain their livelihoods. So that is quite a key thing there. So what I will say is there's so many different options with these types of solutions that we can have. There are also even further solutions around somehow integrating disaster risk insurance within current social security schemes that different countries have. And this has been done in certain places around the world, but I think there's a lot more scope to look at that going forward. The good thing is that the South African government is currently involved in projects to try and look at this, seeing the sort of impact of disasters on economies and on development, and noting that it is a very key issue to try and address. So what I do hope is that in future, I can speak to you more about the solutions that have been implemented as opposed to the solutions that really could be implemented. Perfect. And I will say thank you there. I note my time is running out. So what I'm going to do is answer the questions in the Q&A. I'll just do them by type some answers up there. And thank you everyone for listening today. And I'm going to hand back to Kylie.
Now, you might be wondering why it's me here and not Christelle. Well, I hate to tell you, but the lady is off in Paris drinking champagne, so you're kind of stuck with me. But you're in good company, which brings me to our next speaker, Themba Sibiya, Executive Manager, Strategy and Underwriting at Sasria. He knows a thing or two about managing risk in high-stakes scenarios. Here to unpack SRCC and terrorism risk management, it's Themba Sibiya.
Good morning. Thank you for the opportunity to be invited. We're going to talk about SRCC, and I hope we will find more information. So I just need to switch things around. Yeah, perfect. All right. Please never mind. I won't be focusing on the camera. I'll be looking at the presentation screen, but pay attention to the presentation, and we will start. So the topic for today is the management of SRCC and terrorism, and we're going to look at the changing landscape and of the political violence and terrorism space. So the items that we'll be talking about, it's the comparative overview, advancements, the evolving trends, PVT and NetCat. Haley has covered that part, SRCC, the interconnection between various aspects of the socio-economic issues, the impact to the insurance market, and then we look at event costs, the outlook, future outlook, and then we close. So if we look at the definitions of the political violence and SRCC and terrorism, political violence was mainly designed, was mainly designed for regime change. So its main interest and objective is that by the time people finish with the protests or the exchange of their grievances with whoever, there should be regime change. SRCC, which is strike, riots, and civil commotion, is mainly geared towards protests that are from individuals or pockets of society, but they are addressing smaller things other than regime change. And I think that is the difference there. Whereas terrorism, we know it can be perpetuated by groups. We can have Lone Ranger, it can be state-sponsored, and ideally it is there for, influence of government or state to achieve a particular objective. But when you look at how these perils have changed over the years, you can see that when you look at the global landscape, things seem to be intertwined, and the challenges are around security, economy, and social challenges. The economies are struggling. People are finding it hard to get work. There's a number of things. If you look at the protests around Nigeria last year, they were mainly influenced by corruption. Bangladesh, they were mainly influenced by the change in terms of labor relations and so forth. So we are going to cover a number of areas where we see the differences between the two regions. But what I want us to talk about is how the different global regions protest. If you look at the difference between the global north and the global south, and the typical economic status there, global north, we know they are happening and they are living large. Global south, we're still starting to develop and we're pushing industrialization. The historical context of the two is that the Global South was mainly colonized, and there's weak institutions, and we've seen that in terms of how elections are managed within some of the countries within the African continent. And those breed dissent between the citizens and the state, and how people in the Global South relate with state. We see the state as an antagonist, someone we need to fight with, whereas the colonizers look at more of the social issues and how to refine state policies. But if you look at the theories that drive some of these things, the emphasis around the colonized nations, former colonized nations, is more about class accessibility, improving the lives of people, and making sure that people are not adversely impacted. And when you consider some of the examples that have taken place in recent years, Arab Spring is something that comes to mind. And the formation of SASRA, which was influenced by the June 1976 and the apartheid movement and all those things, those are the things that bring that you need to pay attention to and recall when we talk about SRCC and PVT. But when you go back and look at how protests have been undertaken over the years, you see that the evolution around the printing press, and we'll go back, you'll see, and you look at the pictures, that most of the time people would go out there, they'll have beautiful placards, everything is printed and stuff. And how the states would deal with that is that they'll want to suppress the printing of materials and have control just to minimize these things and the protests. Now, the Telegraph one, I think, was a shocker as I looked at these developments. I mean, for South Africans, receiving a telegram it's bad news. You know that, and it was brief. When you are somewhere at the office and then they call you from the factory shop or wherever, and then they say there's a telegram for you, you already know that someone has passed away. And it will be brief, there will be no details. Someone say, Ubabu shonile, come back home. So I was wondering how they were able to manage the telegraph thing and to coordinate the strikes and the protest. In the research, you see that what brings a huge shift in terms of the SRCC and PVT is the advancements around television and radio, where there's a huge reach in terms of listeners and people who are watching television. So people can be easily influenced, messages can be recorded, and there's dissemination of information through radio. And years ago, even though the ANC was outside of the country, there was Radio Lusaka, where you could still listen to some of the material from the ANC or any other political party, where they would share nuggets in terms of what they are seeing and the things that needs to happen in the country. So those are the things that transform the nature and the fabric of communication, the sharing of disagreements and the raising of issues, and for people to say, let us come together. Now, what compounds the challenges now is the social media. The use of social media during the Arab Spring, things went from a small protest to a protest that affected the region as a whole. And the key main source of activism that took place was driven mainly by social media and access to internet. The emerging one now, which brings a lot of problems, is that now there's the play of AI, and AI comes with deepfake, comes with bots, comes with automated disinformation, and a lot can be done. And negative information can be shared, and those can push people to follow an incorrect narrative, and then they protest, and you see that whatever it is that they are protesting for is ill-informed. So the PVT and SRCC space is evolving, and we are seeing that in as much as there was a formation of a large number of people, there are lone rangers now who appear radicalized, and they are mainly radicalized by what they consume within the social media space. And then we're seeing that there is more domestic activism and anti-government movements. And we've seen in the events within the US where people stormed the offices, the capital. We've seen people in Pakistan or Bangladesh storming the palace and taking over the palace for a number of days, where the president and the king had to flee and be somewhere. But the huge driver, as we've covered in the previous slide, is how technology is changing things and how everyone is using all this technology to share information. But the hotspots and what is happening globally, those are the things that drive a number of challenges for us. You look at the issues around Israel, Palestine, and now Iraq, and the involvement of the USA. To some extent, Russia was sitting over the fence and trying to look at what's happening within the neighbors, and people posturing to say, touch him if you dare, you will see us. And those are the things that perpetuate terrorism, because people will say, okay, we don't have muscle to fight you, right on, but maybe a terrorist event can show you our might and what we are prepared to do. And those are the things that we need to look at and pay attention to, and to also be mindful of most of the state-sponsored attacks, because those are subtle and people don't pay attention to those ones. But we know that there are countries who would use their resources for state-sponsored terrorism. They will have people operating in different countries, dissemination of incorrect information, the perpetuation of propaganda and all those things. And it becomes a challenge to have control over those things. But if you look at what Haley has shared in terms of NetCat, and you compare it with the PVT and SRCC, you will see that from the Swiss Re report, NetCat, the losses have increased over the years. The average is about 108 billion. The last period where we have proper information is 146 billion. The capacity within the NetCat space is around 500 billion globally. So you can see that there is still a buffer in terms of available capacity. But for man-made catastrophes, where we talk about SRCC and PVT, the average over the 10-year period is around 10 billion, and there isn't much capacity available. So it brings a challenge into this space to say, if anything happens, is there enough or sufficient capacity to respond to these eventualities? And when you look at the comparison between the Latin America and South Africa on the SRCC for a period between 2025 and 2022, NetCat Latin America was around 6 billion. SA is around 2.5 billion. But if you look at the SRCC losses in Latin America, you see that it's starting to be closer now. And for SA, that huge spike there was mainly influenced by the July event. And these are not small numbers to comprehend. So what then the Lloyd's guys did with the synthetic modeling, so they've looked at the USA and said, okay, let's just run a model to see what will be the correlation, or what Haley spoke about, a secondary event where you have a net cat event taking place, and then it is followed by an SRCC or civil commotion. And the estimate from that model is around 20 billion. So this modeling is saying you can have a net cat event, and then the follow-on is extreme, because now you are looking at displacement challenges, you're looking at people fighting for access to food, access to services, and all those things. And if you bring that home to SA and you look at how we've seen things unfold after events taking place in KZN, immediately after a flood that has washed away dwellings, washed away bridges, people can't go to work, people can't access clinics and hospitals, people can't access water because water pipes have burst, and those pipes have been closed to prevent leakages and all those stuff. Electricity is no longer available. Those things trigger service delivery protest, and then we have a challenge now. Communities are up in arms. In as much as we want to fix NetCat related things, these are now compounded by SRCC events. The SRCC, over the years, it's growing. The Swiss Re report indicates that there has been a 3,000 increase of SRCC claims globally for the 2 decades. And it's not surprising, because we are seeing these things unfold in the televisions and in the media. But the key drivers here are economic inequality and hardship, political repression, social media amplification, and urbanization. Now, urbanization for South Africa becomes a problem. Those who live in fourways or in these Lani areas, you know who is your neighbor. Your neighbor's house looks far cheaper than your house. And if you look at the issues of inequality, and where you would find your estates and where you would find houses like Cosmo, you'll see that, okay, shacks are now moving closer and closer to these so-called upmarket houses. And that's mainly driven by urbanization, because people want to be closer to their places of work. These significant SRCC events, we are going to talk to them. But what I want us to focus on now is that the key drivers have led to these massive losses. And the underlying issues during that time were all these key drivers. Anywhere in the world, you would see that these key drivers are there as an underlying matter, and then they push for these things to happen. The interconnection, there's bloodlines now between terrorism and civil unrest, systemic inabilities, and you can see that the socioeconomic issues are a challenge. Global contagion, it's easy now to know what is happening anywhere in the country. And it's also easy for people to sympathize with you wherever they are and to run a protest of their own in their own country in support of what is happening in any other country outside of their main country of residence. And if you look at the global unrest and the frequency is going up, but mainly these things are failure of political repression and civil rights, economic injustice, and anti-austerity. We know what happened with us with all the austerity measures. And if you look at the risks that South Africa is facing and the event count, you can see that we are on an upward trend. But what I wanted to do was then to say to our BI team, they've run an exercise and then they've shared this slide with us. So this slide says, okay, we've always known SA to be the capital of protest, and we've also pushed that we are the protest capital of the world. But if you look at the protests per million people, then you see a different dynamic. Our neighbors, Eswatini, come up on top of us. We may have a number of protests, but if you look at the population there and the number of protests, and you look at that ratio per million people, then you can see Brazil comes up. That should not be a surprise. Brazil has a number of people living there. Kenya has a lot of people. Nigeria has a lot of people. And then Eswatini comes up. And we know that things have been happening in Eswatini over some few years, and we've seen a number of losses taking place there. But we're not seeing this noise coming out in terms of damages taking place and significant issues. But we are there as number 6 or 7 in terms of protest per million people. The Santam barometer presents a very interesting outlook. If you look at the risks identified by consumers, out of 10, 7 of those things are mainly socio-economic issues, cost of living, societal issues, economic challenge, climate-related, political risk, load shedding, and unemployment. So people are saying, we're saying these are the risks, and you look at the nature of protest, and then you can see that, okay, people are serious about these things because this is what is happening in the country. The joke is what the commercial and corporate clients are seeing. They're looking at crime, they're looking at challenging economy, poor infrastructure, political unrest, cybercrime, climate change, regulatory thing. But crime is mainly driven by the things that worry the consumers, because there's unemployment, there's poverty, there's inequality, and what do people resort to do? They will go jump a fence, get the merchandise, and do whatever it is that they want to do. CIT is influenced by those things. So you can see that in as much as we are seeing things from a different lens and a different perspective, there is some correlation in terms of the underlying drivers over the things that concern both the corporate world and the consumers. And if you look at the issues that drive these losses, SRCC, if you look at all the cat events globally, there's underlying issues in that country. But there is this one straw that breaks the camel's back. And if you look at SA, it was the incarceration of former President Jacob Zuma. And this led to 9 days of losses. 32 billion rands worth of losses that we had to pay. And everywhere, every sector, every area in KZN was targeted, and opportunistic crime also took place, and others have been arrested, others appeared in courts in recent days. Every sector had to bear the brunt of the dissatisfaction of the people, be it retail, be it trucking, be it the blood bank, be it a mortuary. We didn't spare anything. But the overall cost of all these things anywhere in the world amounts to significant amounts. It becomes a huge thing. New Caledonia sits east of Australia. No one knows about that island, but the losses there are $1 billion. The French, they've been at it for some time. It started, when you look at the losses in 2018, the yellow jackets and the yellow vests have been there, and everything that they touch, those guys, it's magic, you know. They ban the. I think me joining some of the South African guys with Louis Vuitton and how big it is in France, I'll be the first one going in there, you know, get a bag or so. But I don't want to be arrested. Now, these are the areas, and you can see the landscape and the length and breadth of these protests. We mustn't forget that somewhere in the mid of Africa, there is a Sahel region, which is mainly influencing the terrorism space. And that is where most of the terrorism takes place. And those are countries like Burkina Faso, Niger, Cameroon, Sudan. So in as much as Africa has us on the strikes, the Sahel region has the highest number of fatalities in terms of terrorism and the highest number of terrorist attacks and the highest concentration of terrorist groups operating in those areas. And then these are influenced by social media, climate change, downright democracy, and a number of things. Now, the impact of all these things in the market is that the market hardening takes place. We struggled for years after July 2021 to find capacity for our reinsurance program. It was tough, and we couldn't get capacity easily, and prices went up. And what we've seen is that the market moved away just to protect the book. And we saw a number of wording changes taking place, the restrictions that were imposed on us because the market wanted to underwrite the book properly. And as we look at the outlook going forward, you can see there is continued volatility unless human issues are changed. We are not going to see the end of SRCC and PVT. The region has a high level of instability. There are a number of things happening within the Sahel space, and there are issues happening in SA. We've seen them corners matter. We've seen the Dudula issues. We see a lot of things happening in the country. So unless we solve all of those things, we're not going to see an end of these things. So one would ask, what is it that we are doing as SASRIM? So we have developed a system where we are looking and paying attention to what is happening in the country and to have a deeper understanding of the protest. And if you look at the outcome of our BI analysis tool, we are able to pinpoint where issues are happening, who's doing what, where, and when. We are tracking conversations around the social media space, and we have plotted properties from the data that we are seeing coming from municipalities, and we are looking at our claims data and to see where these protests coming from and what type of these protests are taking place. You can see there's more violence, there's more riots, there's a number of protests, and these are mainly taking place in the three major cities, Cape Town, Johannesburg, and KZN. Now, if you look at municipal IQ and you zoom in on what the issues that affect municipalities and drive dissatisfaction within the municipal space, you can see that service delivery becomes a problem. There's corruption, councillors, issues, electricity, housing, informal settlement, and water is becoming a challenge. The availability of water and having water on tap for a number of days becomes a challenge. I mean, there were people who were protesting, I think in KZN or somewhere, they haven't had water for about 4 or 5 days. Ekurhuleni, we know that the province wanted to introduce tariffs. There was pushback in a number of locations of Ekurhuleni, and we know that somewhere in Northwest, people are still without water, and access to health facilities is a challenge, and that informs the Dudula type of protests that are now spreading all over the country. So my time has come up. This is where I'll say thank you, and then I'll take questions on the chat. Thanks.
I keep my eyes out and I'm watching the world with my feet. This is the moment, it's the cold, it's the flames, it's the fault lines. This is the moment, it's the moment we take.
Don't become the collateral damage of civil unrest, strikes and riots. One word can rewrite your story. Sasria. As the only company in South Africa that insures you against civil unrest, Sasria ensures that when things go bad, Sasria makes good.
And now, off the back of an amazing AIE, we've got a update from Thokozile Mahlangu, CEO of IISA. Please welcome her, Thokozile.
Good morning, ladies and gentlemen, to InsureTalk55. I hope you are enjoying the last few days of the cold winter. Today I want to kick off by sharing with you the success of the AIE 2025, which we hosted a few weeks ago. We had almost 1,200 delegates in person at Sun City. We had 30 sponsors, 33 exhibitors, 50 speakers, and over 20 countries were represented. The event was a huge success, and a big thank you to each and every delegate that took the time to join the community of the AIE. We also want to express our sincere appreciation to our sponsors and exhibitors, both loyal and those that were coming through for the first time. We believe that we've given you an experience that will make you want to come back to support the AIE. We introduced what we called AIE TV this year, where we had on-site capturing the happenings of the conference and the engagements with the attendees, sponsors and exhibitors. So take the time to enjoy the content that we have published on our YouTube channels, showcasing the work that we have done on AIE TV. It was amazing. Registration for AIE 2026 is already open. That's the super early bird registration. So take the time to register so that you enjoy these discounted rates and also get the opportunity to book your preferred accommodation early. As you know, it does get filled up quite quickly. Moving on to a golf event that we'll be hosting on the 30th of October at the Johannesburg Royal Golf Club. That event is an event where we bring our members together. It's a member engagement or a member connect event where we pull members together and they have an opportunity to engage in a professional yet social setting. It's an opportunity also for our corporate partners to engage with members and really have the opportunity to sit back, reflect in those engagements. We are committed to skills development, as you know by now, and one of the challenges that the industry has been communicating to us is the challenge of technical skills or technical knowledge. We have therefore partnered with the Institute of Loss Adjusters with the view of bringing a loss adjuster development program, which is sponsored by SASRIA. We also have engaged with FIA, and we are pulling our heads together to bring on board a broker development program. Both these programs are sponsored by SASRIA and we are focused in making sure that we grow the technical skills that the industry needs so much, and we ensure that there isn't a vacuum in the industry as the older generation retires or starts winding down. What I also want to touch on with regards to the broker development, there's a partnership we started a couple of years ago where we pulled the industry together, and there's funding provided to us where we are able to provide broker development on different areas where we support SMME brokers. And we also take the SMME brokers to conference where they have an opportunity to unlock certain relationships that they ordinarily would not have an opportunity to, one, and secondly, to also have an opportunity to create new either binder relationships or business opportunities. And this year we had the opportunity again to take about 11 brokers to the conference to enjoy this opportunity. That is just another way we are continuously making sure that we contribute towards the technical skills of the industry. As I close, it is Women's Month, and we want to just honor the resilience, leadership and impact of women in our industry and beyond. Your contributions continue to shape stronger organizations, drive innovation and build a more inclusive future. As we celebrate, let us be reminded that when women thrive, industries grow, communities prosper and societies transform. So here's to empowering women, breaking barriers and creating opportunities for next generation of leaders. Thank you until next time.
Welcome
to AIE 2025.
From Mauritius to South Africa.
We are back at Sun City. Welcome to AIE 2025. The theme for AIE 2025 is the Baobab Advantage. We kicked off the day with a welcome procession where we just shared with the delegates what was to happen for the morning. We then had Mr. Mteto Nyati sharing with us some key nuggets about leadership and how to really lead people and making sure that you lead with purpose.
I think the African Insurance Exchange is an amazing platform for brokers to come in, an insurance community to come in and interact, to come in and make room for each other.
I think one of the topics that was discussed today was collaboration. Collaboration both domestically and throughout Africa.
With that, we will see you tomorrow, bright and early. Please make sure that you are seated by 8:45 so that you can get the nuggets from Brent Lindoki and Wendy Mina. See you tomorrow.
Welcome to day 2.
AIE 2025 2025 has been yet another amazing conference. Last night we finished off the day with a gala dinner. What an amazing time we had. At the gala dinner, we started off with the presidential changeover, where Mr. Colin Molepe handed over the reins to Mrs. Nkita Sangweme, who is now the new president of the ISA. Tomorrow we are going to visit the 2 schools that we have adopted here in the Northwest. This is our CSI initiative. What we're going to be doing tomorrow is to have a mini insurance apprentice session with the young people, and this is our way of elevating awareness of the insurance profession to the young people. AIE 2026 registration super early bird is already open and available on the IISA website. So take time, take advantage of the early bird registration. A big thank you to all our sponsors, exhibitors, new attendees, veterans of the AIE, all speakers. Thank you. We really had an amazing time, and we look forward to hosting you again in AIE 2026.
Thank you, AIE. See you next year.
Thank you, AIE.
Thank you, AIE.
Thank you, AIE. This has been a fantastic conference and exhibition. We look forward to 2026.
Hi, I'm Llewellyn from CN&CO Events, and I want to say thank you to every single person that joins InsureTalk every single month. CN&CO started this initiative in the COVID days with only 80 people online, and currently we have over 4,000 people subscribing to InsureTalk, getting their CPD certificates online with us each month. So thank you very much, and thank you to all of our partners for the support, and without you we cannot do this. Kurt, Blake, as well as Colin has been meeting some of our partners here at the InsureTalk stand, which is also a first for us being here at AIE 2025. So thank you to Santam, OMI, Discovery, Global Choices, SHA, My Way, and all of our partners that have been here coming to say hi at the AIE. We really thank you for all of your support throughout the years. We are only going bigger and we are only going better. So stay tuned. Make sure that you register each month at insuretalk.co.za or on the cnandco.com website. Thank you so much, and we look forward to seeing you online every single month. Get your act together. What time do you know? We're gonna just look busy a bit, okay?
But it's what he does. He looks busy every day,
Yeah.
so he's used to it.
This is a productive team.
Llewellyn, another successful AIE conference has successfully concluded here in Sun City. How do you feel?
Tired. My voice, can you hear?
Yeah, voices here.
Yeah, no, I'm super proud of the team. Like I always say, this takes a team to make work. I love my team, as you would have seen in Nonnie's behind the scenes. We're a wild team, but as you can see, Clodagh walking in with big scissors. This office is like a family. For me, I work with a very small team, but I think a very special team. Each member means so much to me. And as you can see on the walls, we make it our home. We have all of our pets here. Each one has something special on their board, and that's how we make AIE special. So I'm really proud of the team. Although we're tired, we worked hard, and I think it was one of the best AIEs that we've seen in years. I'm sure from the design work, Blythe with entertainment, Nati looking after the speakers. So everyone adds in their bit of making it special. And it's making it special for each area and each delegate or speaker, creating an experience. And it's from the moment that people book and register with Clodagh and her team, making sure that that is a special experience. Then we bring it on site. When we come on site, what can we do different? How can people enjoy themselves? Leave the office behind. Come and enjoy AIE. So AIE is fun as well, but there's lots of learning. But in between those learnings, we make it fun.
Absolutely. I couldn't have said it better myself. It's all about the insights, the energy, as well as the connection. And that's what makes this experience a truly, truly special one. Registrations for AIE 2026 are officially open. So do yourselves a favor and book your seat today. See you next year.
Now, most of you are probably regulars because this is an event to put on your calendar. But if you haven't already, there's still a lot more sessions coming up this year. So make sure you register at InsureTalk.co.za. And now time for another monthly update from Rianet Whitehead, co-owner and editor of FA News. Let's see what the media view is on what's shaping the sector.
Good morning, everyone. It's great to be online with you again for InsureTalk. Once again, thank you for the opportunity to the InsureTalk team. I'm Ranet from FA News, and before we get into today's detail, just a quick reminder of what we do. We publish 6 magazines a year, print and digital, and with every edition, you can earn your 3 CPD hours. We also send out newsletters from Monday to Thursday on all the topical industry issues. We also host webinars, and one I want to highlight is the Momentum Insure webinar on climate change happening early next week. I'll be joined by a panel of 5 people, and we'll get into different sides of the climate conversation, from risk management to how you approach conversations with clients, to the kind of collaborations we should be thinking about, and lots more. You can hop onto the FA News website and click on the Climate Change webinar banner to register. And yes, you'll get your CPD hours for that too. The August edition of the magazine is out, and there are some great short-term pieces in there. Cybercrime is on the rise, and we ask, is your business adequately protected? Then there's a piece on when so-called optional extensions actually become essential. We also looked at whether fleet policies are undermining client protection. And there's an article on parametric insurance, bridging the gap between perception and practical use. One of my favorites is the Momentum versus Chetty case, looking at duty of care, speeding, and telematics. And then, if you're thinking about a bit bigger, we explore the future of risk, balancing foresight with hindsight. You'll also find some nice extras sprinkled through the edition, like how claims experience can become brand-defining moment, how AI can sharpen service without losing the human element, and of course some updates around POPIA clampdowns that are worth your attention. A quick reminder of episode 6 happening tonight. The Insurance Apprentice. This episode is sponsored by Old Mutual Insure. It's happening at 7 p.m. on SABC3. This one introduces the Wheel of Fate. And let me tell you, it caused a lot of drama and a lot of tense moments. Something we haven't seen to this level, I think, this year so far. You can watch it online, but I honestly think it's such fun to watch it live on television with the ad breaks and everything. It just feels like proper prime time. If you don't have DSTV, you can download the SABC Plus app, or you can just log in at sabcplus.com and watch it for free. We've added up the views across the platforms of both episodes plus our online stuff. So when I say both episodes, the First episode is on 7 o'clock at night on a Thursday, and then the repeat of that episode is 2 p.m. on a Friday. It's very interesting to see that the views on the Friday episode is much, much higher. If we've added that up, and for the first 5 episodes, we are over 2.5 million views on those episodes. So I think insurance is on the map. I also want to take a moment to congratulate Thokozile, the IISA, Thokozile in particular, as well as Saia, with the fantastic support of CN&CO on an absolutely outstanding conference. Honestly, it was probably one of the best ones I've attended. Now, I might be a little biased here because one of the breakaway sessions was a panel featuring 3 of last year's insurance apprentice contestants, Temwan Yerenda, Rein Schnettler, Tristan Merritt, brilliantly led by Alicia Narayansamy, who herself was a contestant quite a few years ago. It was such an excellent session, and I felt both proud and humble to see it all come together. And then the cherry on top, a visit to the local school where 3 high schools joined us with their grade 11 and 12 learners. We gave them a mini TIA task. At first, the energy in the room was quite low, and I really worried about how we're going to get them to participate. But Temwa quickly took charge, and soon we had the most engaging high energy session. It was amazing to watch, and there's absolutely no doubt that those learners walked away with at least a glimpse of what we do as an industry and the opportunities that are available. And the fact that there is a place for them in the industry. It was a truly incredible experience. So another huge shout out to Thokozile for creating that opportunity, and my team, Temwa and Tristan, who stepped up and raised the energy through the roof. If you haven't seen it yet, go and have a look at the video that the IIS have put together. It's on their Facebook page and also on our Facebook page. You'll get a little glimpse of what I am talking about. Now I want to share something a little bit more serious. Few InsureTalk sessions ago, I mentioned the woman who is scamming people for leads. So this is particularly for brokers that I really want to reiterate it again. We received a letter from someone in the industry, literally 2 in a row, 2 days ago. I'm going to read parts of it because it's a reminder that scams can happen to anyone, even to the experienced people. You think you've heard it all and you've seen it all, and then you fall for this. The email goes, "Good morning. It's embarrassing for me to admit, but after 30 years of experience in the short-term insurance industry, I was scammed. This person presented themselves as a lead generator with supposed contacts inside various offices, insurance offices. They sent spreadsheets and PDFs of so-called leads with names, premiums, policy numbers, even cropped ID numbers and email addresses, just enough to make it look real. I was introduced through someone I trusted who had 2 leads that worked, and that's how it hooked me. I was asked to pay upfront and the balance once the leads landed. I even received invoices. The first conversation looked promising, and then the clients disappeared. A few days later, the same person offered small broker portfolios for sale, 3,000 Rand upfront, and the balance when the book moved. The names of big insurers were mentioned to make it sound credible. In the end, I lost 12,000 Rand before I finally said no. The reason I'm reading this is simple. These scams are out there and they are sophisticated. They play on trust, they create urgency, and they look legitimate on the surface. Please talk to your teams and remind them of the basics. If something feels off, if the details doesn't make sense, if you're pushed to pay up front, walk away. No lead is worth your money or your reputation. So that's our mix for today. Some industry highlights, a little bit of drama with TIA, an update on our school visit with the AIE conference, and an important reminder to stay alert out there. Thank you so much for joining, and enjoy the rest of your InTalk session. And I hope to see many of you on the climate change webinar next week. Enjoy the rest of your session.
Now, before we shift gears, a quick thank you to Business and Arts South Africa for supporting today's entertainment, proving again that the arts and business can thrive together. Next up, we've got an amazing performer, Darren from Cape Town. He's going to be entertaining you next.
What's up, InsureTalk? My name is Darren Govender, and it's so dope to share these few moments with you. I'll be playing a couple of songs that I'm sure you know of. Please do feel free to tap your foot to the beat or whatever floats your boat. I hope you enjoy.
Sunday morning, rain is pouring. Steal some cover, share some skin. Clouds are shouting us in moments unforgettable. You twist to fit the mood that I am in. But things just get so crazy, living life gets hard to do. I would gladly hit the road, get up and go if I knew that someday it will lead me back to you. That someday it will lead me back to you. That may be all I need. And doctor, she is all I see. So come and rest your bones with me, darling. We're driving slow on Sunday morning. I never wanna leave. Fingers trace your every outline. I yeah. Paint a picture with my hand. No. See, back and forth we sway like branches in a storm. Means the weather still together when it is. But things just get so crazy, living life gets hard to do. I would gladly hit the road, get up and go if I knew that someday it will lead me back to you. Someday it will lead me back to you. That may be all I need. Think that she is all I see. So come and rest your bones with me. We're driving slow on Sunday morning. I never wanna leave. So crazy, living life gets hard to do. I would gladly hit the road, get up and go if I knew someday it will lead me back to you. Someday it will lead me back to you. That may be all I need. In doctor, she is all I see. So come and rest your bones with me. We're driving slow on Sunday morning. I never wanna leave. I yeah. That someday will lead me back to you, lead me back to you. I yeah, sing yeah. I yeah. Someday it will lead me back to you. Someday it will lead me back to you, lead me back to you. Someday it will lead me back to you. that someday it will lead me back to you.
That Sunday morning, I'm sure you know that one. The next one I'll be doing, and sadly the last one, is an original song that I wrote recently. It's called Love Again. I hope you enjoy it, and I hope you will hear it sometime soon on your radio stations.
Take a chance and take my hand. I know it gets hard sometimes to move on when love goes wrong. It stains your mind, but leave it behind. I've been there too. I'll carry you through to the other side. So when you're ready, just come and get me. We can learn to love again. I'm not saying it's easy, but I know it's worth it to learn to love again. For you I'll love again. All the times you tried, got caught up in life, and now you think it always ends that way. But you will see what's meant to be. We'll find a way. But I know it's not what I say. It's in who I choose to be to you every single day. So when you're ready, just come and get me, and we can learn to love again. I'm not saying it's easy, but I know it's worth it to learn to love again. For you I love again. For you I love again. Ooh. So when you're ready, just come and get me. We can learn to love again. I'm not saying it's easy, but I know it's worth it to learn to love again. For you I love again.
Thank you so much. I hope you enjoyed that, and I will see you sometime soon.
Right, we're moving into the second half of today, and let's get back to business. Next up, we've got Christine Rodriguez, partner at Bowman's, and she's going to be talking to us about the back to the business of risk. tackling the legal intricacies of contract certainty for complex risks. Please welcome Christine Rodriguez.
Good morning, everybody. Thanks for joining. I will be talking to you today about contract certainty and why it's important in the entire value chain of the insurance distribution. So an insurance contract at its core is just a contract. However, obviously it's amplified because of all the regulatory requirements that are required to be met in terms of legislation. Now, contract certainty is of extreme importance, especially when there's complex risks, because ultimately these complex risks are reinsured. And if there's uncertainty in terms of the underlying insurance contract, that could create issues later on when it triggers a claim under a reinsurance contract. Now, the conflict or inconsistency that is also created when you do not have contract certainty is that it could trigger non-compliance on the part of the parties involved in contracting with the insured. So it's important that the principles of TCF filter down from the underlying insurance policy all the way down to the reinsurance contract. In addition, contract certainty creates some form of market stability because insureds, both customers and insurers alike, are then aware as to what cover they do and do not have. Moving on. Now, what contract certainty showed is how it's imperative underwriting complex risks. The reason being is that you do not want to be in the situation where you assume risk that you never contemplated in actually insuring. From a customer's perspective, their expectation is very, very simple. They've paid premium and they will expect to have insurance cover. Therefore, it's extremely important to have very clear and unambiguous terms in a contract. As a professional, if you do not understand what contract means, imagine the Now, it's the responsibility of the intermediary and the insurer to highlight exceptional terms to a customer. Now, disclosure doesn't necessarily mean information overload. It means you need to highlight to the insured what they're not necessarily expected to be aware of in terms of a contract. So by way of an example, everyone knows that fraud is not covered in terms of an insurance policy. For example, and I've seen this on multiple occasions, including Ombudsman, if you don't, for example, your jewelry in a safe during the period that you're not wearing it, then you are not going to have insurance cover. Or alternatively, if the underlying insured is somebody under the Good morning, everyone. Apologies for that. I see that there was some technical difficulties. I'm not quite sure where we left off on.
Hi, Christine. You can just continue. I think we just lost you for a few seconds there, but we do seem to have you back.
Okay, Great. I will just start again on the slide. So in terms of the contract certainty, it's important that the intermediary and the insurer highlight exceptional terms to a customer. So disclosure doesn't mean that you have to provide information overload, but you do have to highlight to the insured what they're not likely expected to be aware in terms of the contract. So the example being, everyone knows that if you are attempting to lodge a claim and it's a fraudulent claim, then obviously, you will not have cover. However, for example, if your insured is somebody under the age of 25 and they may not have insurance cover if they are traveling late at night after 8 o'clock in the evening, this is something that they should be made aware of, because obviously based on the age group, they might not be at home or be traveling home at 8 o'clock at night. Now, even more so when you have a complex risk such that is insured by SASRIA, it's extremely important that customers understand what type of risk is actually being insured versus what is being insured in terms of the underlying policy. All right. They need to understand which policy will come into effect depending on what insurable event happens. It's important that they understand this, because at the end of the day, if they don't have insurance cover, all of us in the industry face reputational harm. All right. Now, contract drafting, like the law, must be adapted. So the days of copying and pasting from previous precedents or templates is not going to work, right? You can include whatever bell and whistle you would like in a contract where you think it's going to protect your rights. But just remember that if the terms are not actually equitable from a treating customers perspective, they're not likely to be enforced in terms of court. And we saw this with the business interruption claims and the judgments, right? Where we showed that where it is ambiguity, the court will interpret in favor of the customer. So just be mindful of that, and just be mindful in terms of using previous templates or wordings that may have been around years before. Now, we need to appreciate that insurance cover, although it's uncertain, and obviously the contract is also in a way uncertain. Certainty is created where you are able to make it very clear as to the customer as what you intended to insure. Okay, and obviously, if you intend to, what you do intend to insure is perfectly clear, then it at any point in time, if there's an interpretation issue, it's likely to more likely to go in your favor. Okay. Now, there's nothing wrong in having terms which require a client to, in order to enjoy cover, to actually have complied with the terms and conditions of the insurance policy. But what is important is that the customer actually understands what terms and conditions they have to comply with in order to enjoy cover. So make sure that in explaining any insurance policy to the client, they actually understand when they can and when they cannot claim under their insurance policy. What's also important in terms of the entire value chain is that there's contract certainty also in light of contracts between service providers, intermediaries, and third parties used in the distribution of the insurance product. So where there are binder arrangements, please make sure that these contracts are very clear as to what are the continuous obligations under the contract, what the step-in rights will be in the event of default, and effectively how clients will be dealt with in the event of a termination of this type of arrangement. When it comes to outsourcing of arrangements, also make sure that you take into consideration in your due diligence whether there's any concentration risk within an insurance group or even within your business itself. With premium collection, obviously we saw what happened in the past. Make sure, we need to make sure that there isn't an aggregation risk, even though there's a limit, there may be potentially limited availability in terms of premium collection agents. And finally, with intermediaries, just make sure that your record of advice is very clear and that you maintain the adequate records that you need to. In the event that there is a dispute, you can call on these to assist in terms of contract interpretation or even to assist you in defending any professional indemnity claims that you may have against, made against you in terms of potentially not having advice. Now, the principles to consider to achieve certainty are very simple. The first principle is always ensure that your terms are explicit and they don't bring about any ambiguity at any point in time. Especially so when you are entering into the contract and the offer to contract is accepted. So from an insurance and reinsurance policy perspective, please make sure that there's a detailed record of advice is maintained in terms of the contract and the terms that have been disclosed so that the client is made aware of what they have and what they have not covered in terms of their policy. If there are contracts with service providers, make sure that these allow for adequate due diligence and constant monitoring. In terms of all types of contracts in the insurance industry, make sure that you have adequate in-house legal resources to constantly consider your contracts and also make the required amendments as time goes by. This will achieve certainty. The days of just relying on a template or copying pasting is no longer is a huge operational risk to your business, and it creates even a greater uncertainty. Also, where required, engage with external legal or compliance service providers to provide you with an independent review of your contracts. Where possible, try to use as much as possible standardized documents, or where you are going to endorse or going to make specific amendments to specific contracts, make sure that these are clearly identifiable so that even at any point in time, if you're attempting to enforce the contract, these are easily accessible and you will know where to get information relating to those particular amendments. Always review your wordings and clauses in your contracts in terms of in light of past experiences. It's important to use your learnings. You've paid the school fees, so make sure you don't repeat the same issues over and over again in terms of your current contracting. If at any point in time amendments or changes are required to be made, action them as soon as possible. We all know that with all good intentions, sometimes we intend to do something and we don't do it. It falls through the cracks, and that could potentially create, at a later point in time, issues for the contracting parties. Finally, it is of extreme importance from a risk management perspective, not only just from creating a contract certainty, but to ensure that internally you have adequate contract management and compliance requirements. So with your insurance policies, make sure that the correct version of the policy of the contract is always provided, and that when it is provided, it's either provided in terms of the regulatory time periods, or it's entered in once it's entered into that the contracting parties have been given those contracts in a timely period. The reason being that sometimes the contracts are provided, especially when you look at reinsurance arrangements or even in terms of certain contracting arrangements between service providers. These are provided at a much later stage between the parties. And no one really then goes and reviews. The agreements are signed and they are put away in some drawer, and somebody didn't realize that there was a required amendment to be made. So make sure that you do constantly make sure that you are reviewing your agreements. And finally, make sure any amendments and endorsements are correctly reflected so that at any point in time, if there is any ambiguity or there's any potential conflict, these are more readily resolved because the amendments and endorsements have been correctly reflected. So that's just a very, very quick roundup on contract certainty. I will check any questions that there are in the chat and I will respond. Yes, Bernadette, I think everybody has been struggling today with tech. But thanks, everybody. And reach out to me at any point in time if you'd just like to have a chat.
And right now we're going to take a quick comfort break, so we'll be back in just a bit. Let's take a moment just to acknowledge and thank our sponsors and our partners, our headline event sponsor, Sasria, our CPD partner, IISA, and of course, media partner, FA News. Without you guys and all the incredible speakers here today, none of this would be possible. Right, up next, we've got Mishaya Shettiar, Executive Head of Everything Insure. Closing our speaker lineup with a look into the digital future of insurance, here's Mishaya, a tech-forward leader reimagining how insurance connects with people.
Good afternoon, everyone. I'm sure that all of you are at your limit, ready for lunch, just wanting to get your CPD points and get out of here. So I'm going to do my best to keep this sharp and probably a little bit left field since I'm not your typical insurance person. So let me just quickly share my presentation. Okay. All right. So I'm going to be talking on the future of insurance being digital, but
Sorry, Mishaya, if you can just share your screen again. We don't seem to have your slides on.
Oh dear, sorry about that.
No stress at all. Thank you so much.
Can you see
Perfect. Thank you so much.
Okay, cool. So I'm going to be talking about the future of insurance being digital and what's the next frontier, how AI and marketplaces are transforming insurance. So before we get started, quick intro into who I am. So my name is Mishaya Shettiar. I'm the executive head and co-founder of Everything.Insure. My background is not what you'd call a traditional insurance journey. I actually started in the world of technology, building systems, solving problems with code, and imagining how industries could be reshaped if only we would step away from the slow, paper-based way of doing things. So when I entered insurance almost 8 years ago, I'll be honest, I felt like I was stepping into a time machine. No offense to all the insurance people on the call, but processes that in other industries had been automated or digitized were still locked in manual forms, Excel tables, legacy systems, and long phone calls. That frustration and also that opportunity was what led to the launch of Everything.Insure in 2018. So from day one, our goal was not just to make a single Apple platform. And don't worry, this is not a talk about Everything.Insure and who we are. But our goal was to build something for everyone in the insurance ecosystem. For the consumer who just wants to understand their cover and get a fair price. For the intermediary who was trying to service clients without drowning in admin. For insurers who are trying to keep up with digital demand. And even for enterprises that want to unlock new revenue streams, but offering insurance to their members or their employees. We wanted to take insurance into the future and prove this industry could be just as innovative, just as tech-driven as any other. Now, everybody on this call is either in one of those four spaces, but we're all in the consumer space. So let's talk about where digital insurance stands today. Digital insurance is starting to become more prominent. We've seen a lot of progress in digitizing traditional processes, from online forms to call center automation, from web portals to mobile apps. But let's be clear, that's not the final destination. That's only the starting point. You see, every other industry has followed this exact trajectory. First, traditional processes got digitized. Then those digital processes evolved into marketplace models. And I believe with absolute certainty, financial services and insurance are going ahead in the same direction. So let's think about how we shop. Clients used to walk into a store, they used to talk to a salesperson, and they then would buy what they needed. Then online shopping became prominent. It solved the issue of accessibility. Suddenly, you could be sitting in a small town far away from a city or in a place where there was no Zara nearby, and you still had access to products and services that might never have been available to you locally. But it didn't stop there. Online shopping then evolved into marketplaces. Platforms like Amazon, Takealot, Hopper, AutoTrader, Property24, Expedia. No matter what you want, a jacket, a flight, a hotel, a car, a home, even a vacuum cleaner. Today, you and I go to a marketplace. No one goes to SAA's website to get a price for a flight, then switches over to Emirates to go and compare. We go to Discovery or TravelStart or Hopper. When we're looking for a home, we don't go to Pam Golding and then to Seif to check property listings one by one. We go to Private Property or Property24. Why? Because marketplaces solve three major problems: accessibility, pricing, and effort. They don't give you the access. They don't just give you access. They save you time. They give you the tools to compare. They guarantee you one consistent buying and post-sale experience. It's not just about choice, it's about predictability. Think about Amazon, or in our South African context, probably more Takealot. If I buy from Amazon or Takealot, I know exactly what to expect. I know what the search experience is going to look like. I know how to compare. I know what the checkout process is going to be. I know what the delivery will look like. And if something goes wrong, I know what the return process will be. It's predictable, it's consistent, and it's low effort. That's exactly why marketplaces have taken off. Now bring that logic into insurance. Right? Insurance is even more tangible than a jacket or a car. It's closer to buying a flight. You can't touch it, you can't test it, you just have to trust that the experience will deliver. And because of that, insurance won't face some of the hurdles that online clothing retailers did. There's nothing physical to try on, send back, worry about fitting. It's perfectly suited for digital distribution. But right now, insurance is still complicated. It's tedious. There's endless forms, there's long calls, there's confusing terms and fine print, processes that feel stuck in another decade. So just for a second, I want us to imagine this. You answer a few questions online, guided every step of the way, advice given to you on questions that might seem confusing. In seconds, you see multiple quotes side by side, recommendations and advice provided to help you. You choose, you buy, you're covered. And if you need to make a change or submit a claim, you do it easily. No paperwork, no waiting, no frustration. You need to change insurer, you just do it in a few clicks. No further effort, no further phone calls, no further paperwork. That's not just convenient. That's the future, and we believe it's inevitable. Right now, we've seen amazing digital startups coming up where you can do most of that journey for a single product. We think the future is the same kind of journey, but end-to-end, multiple products. Now, here's why this shift can't be stopped. The next generation of insurance buyers, millennials and Gen Zs, are already the majority in many, many sectors, and they demand digital, frictionless, marketplace-driven experiences. Once they have that option, they'll never go back. So, as you can see here, right now we've still got boomers and Gen Xers as the bulk of our insurance buying, but that's going to change over the years. If I think about my 7 and 8-year-olds, they don't even know how to talk on a phone by putting it next to their ear because they're so used to having FaceTime calls. When these generations come into the insurance market and make up the majority, they are not going to accept anything other than what they know, which is digital marketplace. So, what does this mean for insurers, for brokers, for binder holders? Us as Everything.Insure are part of a broader group that has all of these players. So it means we're standing at a turning point. Either we see the shift for what it is and adapt, or we risk being left behind. Now, for those of you skeptical, thinking that maybe I'm wrong, before I dive into AI and the future of insurance, I want to take you back to 2010. At the time, I was completing my honors thesis, and I decided to ask a question that felt a bit provocative for the insurance industry. Would insurance ever go digital? To answer it, I went out and interviewed 2 groups. On one side, I spoke to consumers from all different demographics. And on the other side, I spoke to the C-suite of insurers, from Hollard to Santam and everyone in between. The responses couldn't have been more different. On the consumer side, 84% across all age groups and all income levels said they would definitely buy insurance digitally. And not only would they do it, they would prefer it, provided, of course, that it was simple. And the key requirement that came out was that they needed to be advised along the way, and they wanted the assurance that a human being was still available if needed. Now, at the time, a few sort of digital platforms did exist, but consumers had a real issue with them because they weren't truly digital. At some point in the journey, it all got handed over to the traditional process of call centers and paperwork. Now, here's the fascinating part. When I spoke to the insurers, a staggering 98.4% of them said the exact opposite. They said insurance was too complicated, it was too nuanced, it was too bound by regulation and underwriting to ever really go digital. So on one hand, you had consumers saying, yes, we want this, please make it easier. And on the other hand, you had insurers saying, it can't be done, it'll never be done. Now fast forward 6 or 7 years from then, and what happens? True digital players emerge. Suddenly, thousands of consumers are quoting and buying digitally. Exactly what consumers had predicted, and exactly what insurers said would never happen. That story is important because I believe the exact same thing is happening again today. As traditional digital as we know it starts to take off and take more and more market share, which it inevitably will, we need to think about what's the next. The debate is no longer about whether insurance will digitize. That's already happening. The debate is now around marketplaces and about AI in insurance. And once again, consumers are already there. They want it. They're waiting for it. Every other industry is adopting it. And once again, much of the insurance industry is still saying it's too complicated. It can't be done. But we've already seen how this plays out. Consumers will drive the adoption and insurers will be forced to follow. The question is who adapts early and who gets left behind. So let's talk a little bit about AI. I'm sure everybody on the call has used ChatGPT or Claude or some AI to write their emails or Copilot. But let's focus a little bit more about the cutting edge AI in insurance, because this is where it gets really interesting. Right now, creating an insurance product takes months, if not years. Even digitizing products that exist can take months to years. You need actuaries to build rating tables, you need underwriters to administer rules, you need teams to build policy wordings. But in a world of AI, that entire process can be condensed into minutes. At Everything.Insure, we've built what we call an AI workforce. We continue to add to this workforce all the time, but these aren't gimmicks or toys. These are AI agents that can handle underwriting, rating, fraud detection, product training, client advice, and even product recommendations. There's an international AI conference, not an insurance one, but an AI across industries conference that happens every year in the USA. And globally, according to the research done by this conference, 67% of the current use of agentic AI is happening in the insurance industry. And that number is only going to grow. That means that the second is agriculture, the third is medical. So AI is being used mostly in our industry. So let me give you some practical examples. We've got an AI agent called Evie. She can be trained on any product in under 30 seconds. It used to be 60 seconds. We've now got it down to under 30 seconds. All we do is upload whatever we want to train her with. It can be policy wording, underwriting guides, schedules, FAQs, or all of the above. And within the last time we trained it on a product, 27 seconds, she can answer any question that you or I or broker or client might ask her. What's covered? What are the limits? How does the excess work? She can respond instantly and accurately in plain language. Then we've got our underwriting agent. This one can be trained on any set of underwriting rules and apply them in real time, consistently and digitally on every single policy. As a client answers questions, it can decide whether a policy can be bound online or not, and even generate the exact wording that needs to appear on the schedule based on a client's specific profile or risk rating. The actuary agent works the same way. It recommends loadings or discounts. It calculates the right excess. It applies rating factors in real time. What would take years to train a human underwriter, broker, or actuary to do can now be achieved by AI in minutes. And this isn't just about quoting. The underwriter agent can check post-sign-up submissions, like proof of ownership or video of your car, and process them the same way a human would. Our claims agents can detect fraud, identify suspicious patterns, and even suggest new underwriting rules to reduce risk exposure. It's not just us that's building it. There are companies and insurtechs all around the world building using AI to solve real insurance problems that you and I face every day. If the action a human would take is predictable and repeatable, then it can be codified and learned by technology. So this is the question that we all ask. What does this mean for our human workforce? It simply means that actuaries and underwriters can stop spending their days on repetitive admin and start focusing on higher order functions. They can analyze the market, they can study the data, they can design better, more bespoke products. Instead of taking months to manually create comparisons when a product wording changes, the AI does it instantly, and this human simply verifies. Months of work becomes days, and the outcome of that is profound, because insurers can now take a product from concept to fully live, fully distributed in weeks, not years. So at Everything.Insure, we did a test case. We built an entire professional indemnity product in 48 hours. From concept to underwriting rules, to rating, to policy wording, to endorsements, to digital distribution. Everything. The only delays we experienced when we do product setups in our environment is because of the traditional insurer processes and legacy systems. And that right there is the real bottleneck. It's not the consumer, it's not the technology, it's the legacy processes that slow us down. Now, we don't need to waste time talking about what's going to happen to all our jobs. We don't need to worry about that because advancement in technology has threatened to take people's jobs before, from the printing press to electricity. Instead, it just forces us as humans to evolve and innovate, break new ground and create new higher order roles. When Excel came in, it didn't kill jobs, it killed the calculator. It enabled us as humans to just level up what we were doing in our businesses. And we just need to see AI as doing the same. Now that we've looked at AI and what it makes possible, let's zoom out for a moment. Because when you think about the insurance ecosystem, there are 4 key role players. Well, there's 3, but with the introduction of technology, we've added a 4th. Consumers, intermediaries like brokers and binder holders, insurers, and we've added enterprises. Each one is facing real, tangible problems, and if we don't address them, all the technology in the world won't matter. So let's look at all 4 role players one by one and how AI, marketplace, and tech is solving their problems. First, the consumer. For consumers, insurance is still sold, not bought. As an insurer, we can come up with the most amazing cyber products or products to solve whatever problem it is, but how does the consumer find out about it? How does the consumer access it? It's locked behind brokers, paperwork, and call centers. Switching is confusing. It's time-consuming. And to be honest, it offers no clear benefit, and nobody wants to get an insurance quote more than once in their life if they can avoid it. There's no central marketplace where you can compare or manage your cover, just sales pitches and jargon. Most consumers don't even know what can be insured or what makes for good cover. For many people, insurance feels like a luxury, not a necessity. They don't have tools to explore affordable options, and so, for the people who need it most, insurance remains invisible, inaccessible, and unaffordable. So, what do people do? They either don't buy at all, which is a large majority of our country, or they buy from the company with the biggest marketing budget, or they push, buy from the company with the biggest marketing budget, or they push their brokers for the best price. And it becomes a race to the bottom, as you all know. There's no consideration for the fact that, like cars, not all brands are equal, and not all cover is equal. We get what we pay for. So that's the problem. But here's the solution. At a marketplace like ours or a few others, the consumer gets one platform for everything. They can compare, they can quote, they can switch, they can buy across insurers, across product types. They don't have to guess because AI guidance explains the cover clearly. It shows them smarter choices and it tailors their protection to their needs, their budget, and their risk profile, all in real time. Marketplace logic means they're shown products they might never even have found on their own. They come to insure their car and they find out about cyber or pet along the way. And the best part is no paperwork, no sales push, no confusion, just insurance on the consumer's terms. We are able to turn the grudge purchase into a smart purchase. That's how you make insurance easy to understand, easy to buy, and easy to afford. As great as this news is, many consumers still want peace of mind of using a broker, which is obviously great news for us. So let's move on to the broker. Brokers are overwhelmed. We don't have a single dashboard to run our business. Everything is fragmented, time draining, admin intensive, and error prone. Watching some of the brokers in our offices trying to get quotes on the traditional systems, it can take them days just to get out a few commercial quotes or even personal lines quotes. Binding takes paperwork. Most brokers only ever offer 1 or 2 insurers. Compliance is a nightmare. Advice, disclosures, record keeping, keeping up to date on product changes. It's all manual, it's all risky. And then you add the fact that managing diverse product types like cyber, gap, pet insurance often requires multiple licenses, or completely different brokers. It's impossible to stay up to date on every product option, and so brokers fall behind digital-first platforms. Brokerage growth becomes limited due to admin and high staff costs to try and keep up. Again, that's the problem, but here's the solution. At a platform like ours, technology has enabled us to give brokers a digital broker dashboard to run their entire business. They can quote, compare, bind, service, and renew instantly. Everything that's available to the consumer directly, plus more, is available to the broker to be able to service those consumers. Multiple quotes for any product in minutes, with built-in comparisons and recommendations, advice, disclosures, compliance, all automated with AI, backed by our robo-advice license. So brokers get access to a wide inventory of products without needing extra training or extra licenses. They can cross-sell, niche sell, grow their practice without extra admin or red tape. In other words, we turn brokerages into a digital powerhouse without the extra staff or costs. Now, what about the insurer? Here's the reality. As we said, new products take 12 to 24 months to create and launch. Digitizing them takes even longer. Insurers are stuck with legacy tech, custom code, siloed teams. All of it slows down innovation and drives costs up. Distribution is fragmented, inconsistent, and missing the kind of marketplace logic that consumers are looking for. Risk control is shaky because underwriting, pricing, and advice all vary depending on which channel or individual is involved. And on top of that, fraud, leakage, overheads are eroding what is already thin margins for insurers. So insurers are stuck in the slow lane, burning budget just to stand still. So what's the solution for them? Again, with platforms like ours, insurers can launch new products in weeks, not years. No dev team required. Our low-code tools, and there's many platforms that do versions of this, and AI workforce handles quoting, wording, underwriting, compliance, all of it. And distribution becomes simple. Now insurers can reach brokers, enterprises, and consumers in one move, or go direct if they choose. AI ensures consistent pricing, rating, and advice at scale. The result is lower admin, reduced fraud, more cross-sales, and higher margins. In other words, we give insurers a fast lane to future-proof distribution, smarter risk, and real profitability. Insurers can now respond instantly to claims or market trends, change pricing, add underwriting rules, or add questions in minutes. Insurers get to focus on creating the products that brokers and clients are looking for. Brokers get to focus on the part that they probably love, which is the relationship with clients without being bogged down by admin. And finally, the fourth channel that we've unlocked or digital platforms have unlocked, which is enterprises. Employers, schools, sports clubs, unions, they all sit on massive networks of people. Employees, members, communities. And yet, enterprises can't sell insurance. They're blocked by compliance, regulation, and cost. They can't quote, they can't advise, they can't bind or manage claims. Their networks go untapped because their communities are unprotected, their revenue streams are unrealized. The very groups that are best placed to grow insurance access are locked out by red tape. And intermediaries and insurers like us can't sell to these bases easily because of our archaic systems and processes. But here's the solution. With platforms like Everything.Insure or other digital platforms, enterprises don't need their own licenses. We hold the robo-advice license, which means that they can distribute insurance compliantly through our platform. Our journeys are plug and play, no tech build, no licensing effort required. They can offer tailored schemes, cross-sell or bundle protection embedded seamlessly into their ecosystem, and all the sales, all the service, and the claims are handled by a digital marketplace with hybrid AI human support. That means any organization, whether it's a school, a union, or a major employer, can launch a digital insurance business in days, not years. And when you put all of that together, consumers are empowered, brokers are digitally enabled, insurers are faster and leaner, enterprises are finally unlocked, and you start to see what the insurance future really looks like. So where does that leave us? We've looked at consumers, brokers, insurers, enterprises. We've seen the problems. We've seen the solutions. We've seen how technology, AI, marketplace, all of these things are shaping and reshaping the landscape. But here's the truth. None of this is theoretical. None of this is 10 years away. It's already happening. And the only question is, are we going to adapt or are we going to wait until it's too late? I call this the Kodak moment. Many of you will remember Kodak. Once the most recognizable brand in photography. They actually, believe it or not, invented the digital camera, but they didn't believe that the market would adopt it. So they thought film would always be the core of their business. And so instead of embracing the future they themselves had discovered, they clung to the past. The result? They became a cautionary tale, and the world moved on without them. Insurance is standing at that same crossroads right now. Consumers are ready. They are already digital in every other aspect of their lives. They shop on Takealot, they book travel on TravelStart, they find homes on Property24, they bank on their phones. Why would insurance be the one industry exempt from this shift? And yet, much of our industry still behaves as though it is. Legacy processes, outdated thinking, endless committees and sign-offs, while consumers are out there asking for speed, simplicity, and access. If we don't move, others will. New entrants, digital-first players, even companies from outside our sector, are going to step in, capture the trust of our consumer, and own the relationship. And once that happens, the incumbents don't get back in. The opportunity right now is enormous for insurers. It's about cutting years off product launches and putting new ideas into the market in weeks. For brokers, like I said, it's about unlocking scale without drowning in admin. For enterprises, it's about turning captive audiences into engaged, protected communities. And for consumers, it's about finally experiencing insurance as something simple, fair, and accessible, not a grudge purchase, but a smart one. This is what we've built at Everything.Insure, a platform that brings all four role players together, enabled by AI, powered by marketplace logic, and designed for the future. A platform that proves insurance can be as digital, as innovative, and as user-friendly as any other industry in the world. And make no mistake, this is where we're all headed. The only choice is whether we embrace it now or we look back in 10 years' time and wish we had. So my challenge to you as we close is simple. Don't wait for your Kodak moment. Don't wait until your clients are being served by someone else, somewhere else. Lean in now. Partner with those who are building the tools. Test, experiment, deploy. You don't have to start from scratch. The tech exists. Because the future of insurance is not just digital, the future of insurance is marketplaces, and it is AI, and it's already here. Thank you.
And that brings us to the end of InsureTalk55. It's been an incredible day of insights. And again, we just have to say a massive thank you to our headline sponsor, Sasria, our CPD partner, IISA, media partner, FA News, and of course, all of our speakers and you for joining. It's this community that makes these events possible and so important. So you guys are the lifeblood of this industry, and your continued curiosity and commitment are what keep the engine running. If you or your company are keen to become an InsureTalk partner in 2025, you need to hit up Llewellyn du Plessis. You can contact him at llewellyn@cn&co.com. We'd love to have you on board. Thank you so much for joining us today. Until next time, keep learning, keep leading, and keep protecting what matters.